Stockholders' equity. Everything you've learned so far dealing with stockholders' equity has been that there's two parts to stockholders' equity: contributed capital and retained earnings. And the only thing that we've done in contributed capital is either that somebody gives us money or we sell stock. But we've limited the stock to just the fact that stock is stock. That's not how it works, all right? Stock is sold. There's two different ways that stock can be sold. Stock can be sold as common stock, which is the most common, that's why it's called that, or it can be sold as preferred stock. We're going to go through both journal entries. We're going to talk about why it's done that way. There we go. So why does a company do different roles of stock, and why do they do different roles of debt? First of all, the reason they sell stock and why a company is formed is because it's easy. Any one of you guys right now could go home today and form a company today. It's called a LLC. It's a limited liability company. It provides what's called limited liability in the sense that if you were to be sued, we talked about this in Chapter 1, if you were to be sued and you form an LLC, they can only come after the actual company. They cannot come after you. If you run a business and it's just a sole proprietorship and something bad happens, they can sue you, your family, anything that's attached with your name on it. So most people who are smart, when they form a company, when they run a business, will form a company, and then they are protecting themselves that way. All right, so we keep it a separate legal entity, and then any contract we enter into is entered into through the corporation. Why do we sell stocks and what benefits? Well, the number one reason many people like to enter into stock benefits is that you get voting rights. You become an owner in the company. Now, voting rights, every person that buys a stock that has voting rights has the ability to vote. With every share that I own in AT&T, I have a voting right. But, I say that with a but, while I have 380 shares of AT&T stock and I get to vote on every one of them, I don't even know what percent that is because it's so small of AT&T stock. So it's like 0.00006% of AT&T stock. So yes, I have a vote. Every year I get a voting card. Every year I can vote on the board of directors. Every year I can vote on different things that are going on. I typically don't vote because I also don't know what's going on. All right. Voting, every share of stock has it. Usually when you get the voting rights and you're vested in it, it's something from a standpoint of you own a lot of shares of stock and you are following that stock and you know what's going on. Other reasons people own stock is for dividends. That's why I have the stock. Now, it's not the only reason I was giving it when I worked there, all right, but that's why I still own it. I still own it because it's good stock and I get paid dividends. And we'll talk when we get on dividends, which will really be on Tuesday. We'll talk about the benefit of what those dividends are. I don't take my dividends. I do not take cash. I reinvest them because that $60 check every quarter really doesn't do anything. It doesn't even take a family to 5 out to dinner unless we want to go to Subway or something. So I just reinvest it, and it buys me more stock. Then we have something called residual claims, which is when you can go after what's left in a company in the event that you no longer have anything, and then you have preventive rights. So there are two different. So we're looking at the two different types of debt. We have equity, which is stock, and then we have debt, which is loans. What are the advantages of equity? You have to pay it back. When you sell stock, people give you money. You don't have to give it back to them. It's the best way to get cash. You say, here, let me sell 1 million shares of stock at $30 a share. I just got $30 million. That's awesome. All right, and dividends are optional. Google never pays any dividends. They just got a whole bunch of money. It's wonderful. There are advantages of debt, and a lot of people don't think about that, but the interest is tax deductible. Businesses love to have things that are tax deductible. And then on top of that, your ownership doesn't change. See, every time you sell a share of stock, you are giving away a piece of your company. So the best example I can give of that, and I think I've mentioned this a little bit before, but was with Anheuser-Busch and InBev. And the fact that most of us that live here in St. Louis were very surprised when InBev bought out Anheuser-Busch, only because when we found out that the Bush family owned less than 5% of the stock. Most people just kind of assumed that they owned the majority. Now, majority does not have to be 51%. Majority has to be more than everybody else. And we did not think that was 5%. What happened over the years is they sold off their shares of stock. Did they still own a whole bunch? 5% of Anheuser-Busch stock is still a lot of stock. But they didn't own the majority anymore. And when you sell stock, it's great. You get a lot of money, but you're selling off more and more of your company. When you do that, you lose more and more control. And obviously, in the end, InBev runs that company. So different things have happened. And now Billy Bush, we talked about a week ago how the zoo was trying to buy Grant's Farm. Now Billy Bush has stepped in and said no, he wants Grant's Farm. He wants Craftic, which through that part of the company, he wants it. He wants it to stay in his family, and he wants it to keep it that way. What's going to happen, I have absolutely no idea. But he also said he doesn't want a sales tax increase. Remember how I told you that the only way that the zoo was going to be able to do it was a sales tax increase? He won't do that. He's buying it without a sales tax increase. Now, how will he keep it running? And although I didn't read anything else that went into it, except for the fact that he wants to keep it in the Bush family. It's always been in the Bush family. Some of the Bush family lives in that house still, and that's the way he wants to keep it. So the thing you got to look at and what you end up wanting in this whole thing, and the big thing to keep in mind when you're a company, is you need to take both of these and you need to balance it. You need to have a balance between debt and stock, because then you have the kind of the perfect of both worlds. You have a little tax deductibility, you have a little where you don't change your control, but yet at the same time you're getting some money you don't have to pay back. You got to balance those two. And a company that balances those grit is wonderful. So far, Google seems to be doing a pretty good job. And they do it without paying those wonderful dividends. So, stockholders' equity. This is, why are my lines not going? There we go. So now we got 4 parts to stockholders' equity, and 2 of them are new. Treasury stock and what's called accumulated other comprehensive income. Can be a loss if it's in parentheses, all right? You guys have always seen contributed capital. You've always seen retained earnings, and you got the other 2. Does anybody know what treasury stock is? What is this guy down here? Exactly. It's when the company rebuys its own stock from the stockholders. A company can't buy its own stock and be like, I own myself, and just call it common stock. They have to call it something different, and it's called treasury stock. They can own their own stock, and they have to for a lot of different reasons, and we're going to go through why a company would buy its own stock. And it's very common for a company to buy its own stock. But there's some things that happen. For example, a company can't buy its own stock and then get to vote. All right, so when you buy your own stock back, you lose voting rights. You also don't get to buy your own stock back and get paid dividends. All right, that would be kind of weird also. But you do buy back for very specific reasons, and we will go through those. So let's look at some of our common stock transactions. This is probably, oops, one slide too many. This is probably one of the most important things I want you guys to remember. And this is what I think some of you missed on your annual report. When a company decides they want to sell stock, they go to the SEC and they say, we want to go public, and this is how many shares we want to sell. So they go to the SEC and they are authorized to sell, let's say, 1 million shares of stock. Now, how many shares or whatever, that they determine that, and they go to the SEC. And that is what they are authorized to sell, meaning they cannot sell more than what they go to and ask for. Can they go back later? Yes, they can. But this is what they are authorized to sell. After they go and ask for that, there are 2 different categories. They have what's called issued, and they have what's called unissued. They're pretty self-explanatory. All right? So underneath this, we got issued, which is what has been sold, and we have non-issued, which is what is unsold. So the number of stock that is issued plus the number of stock that is unissued equals our authorized share. So if I have 1 million shares that is authorized, and I have sold 750,000, then I have 250,000 that are unissued or non-issued. Both words are used. Right. So that makes sense, right? Now, the next part is where you guys sometimes get confused. We then take our issued and we separate those out into two different categories. We have what's called outstanding, and we have treasury stock, which after me writing it on the board right now, I will only write it as TS because it takes too long to write. All right, so treasury stock. And you can abbreviate, for your purposes, TS is treasury stock, CS is common stock, and PS is preferred stock. And you can do that, just make sure you use the right abbreviations. So outstanding stock, or outstanding shares, is the number of shares on the market. Right? Treasury stock is the number of shares owned by the company. Outstanding plus treasury equals issued. So outstanding plus treasury equals issued. Issued plus non-issued equals authorized. You only pay dividends on outstanding shares. You only vote on outstanding shares. So when you are calculating your ratios, there was one ratio on your annual report, there were two numbers given on the balance sheet. One was the total number of shares authorized. The other one was the total number of shares outstanding. And the number you needed to use was the total number of shares outstanding, which was in the ratio. The ratio said average number of shares outstanding. But many of you used the average number of shares authorized. You just didn't read it, because the formula said outstanding. So it wasn't tricky from the standpoint that it didn't tell you to use outstanding. The formula said to use outstanding. It's just many of you used it authorized. Now the good part is it's worth a half a point. All right, it's not a big deal. So that right there, you have to remember this. You have to remember this. However you want to write it down, keep it for your magical moment. In a multiple choice, you'll see it on a quiz. All right, you'll see it on your quiz that you take for Chapter 11. You'll see it either in a multiple choice or in a problem, because whenever you do dividends, dividends are always done on outstanding. You will almost always see authorized or issued, but you always want to make sure you use outstanding stock. All right, so you'll always be given two numbers, because in the work world, you're going to have all those numbers in front of you. You've got to know that you have to use the outstanding shares. Okay, you cannot include the treasury. Does that make sense? A little bit? All right, that's just a little bit more explanation. And then treasury stock owned by us. We buy that back. It is owned by us. This should look somewhat familiar. This is what you saw on when you're doing your stock market, or your annual report. Notice authorized, issued. All right. That's how it looked, with the exception of it showed you the beginning of one year and then the ending of that year. Notice how it says preferred stock, common stock. All right. We are going to first talk about the common stock, then we will talk about the preferred stock. We're going to concentrate right on what that circle is right there. The only difference between preferred stock and common stock is how dividends are paid, and that's what we'll talk about on Tuesday. Preferred stock costs a little bit more because you get dividends paid preferred. Okay, you get them ahead of time. So everyone's with me on the authorized shares. That's okay. Authorized, outstanding, issued, non-issued. Okay, so, let's go back here. When I circled this little box, one of the things I wanted you to look at was this par value. My little squiggly kind of got it right there. Par value. All right, you might have seen that. A couple of you guys used that as your stock price. I think it was $5. Some of you guys used 88. We talked about that on Tuesday, or Thursday. Some of you guys used $5 or 5 cents. I can't remember what it was. That's the par value. Every stock, for the most part, is given what's called a par value. Par value is typically a very small dollar amount. And here's the thing that makes a lot of sense to you guys, I'm saying that sarcastically, is that par value is arbitrary. It means absolutely nothing. It's assigned by the people who decide how many shares of stock they're going to sell. The reason that it has nothing to do with market, because market changes every day, right? We just watched the stock market. We looked at Google, we looked at HP, and it actually went up and down while we were looking at it. So par value is not market. But when I tell you that we sold 10,000 shares of stock, and I put that on the balance sheet, when I put that on this statement, if I were to go back and put that on the statement, if I were to sell these 50 million shares of Google at $750 a share, how big would that number be right there in 2013? 50 million times $750. It's gigantic, right? But let me ask you this. Is that really the value of the stock in a year? It's not the value of the stock tomorrow. All right? Stock doesn't keep a value. Stock is we sold a piece of our company. Common stock is just a piece of our company. So basically all we did is get cash. So what we're doing in this file or this placeholder on our balance sheet is showing investors that we sold X number of shares and we got this much cash. And so we assign what's this par value, this arbitrary number. So we can record the number of shares we sold, and we can record the cash, but we can't put that gigantic number in stock, because what happens if Google drops to $100 tomorrow? It won't. But what if it did? And we recorded 50 million times 750 today, and then tomorrow it's worth 100. Is our balance sheet going to be significantly overstated? Yes. But did we still get $750 times 50 million in cash? Yes. So our cash is going to be okay, but our equity side is going to be not correct. So that's why we got to assign this arbitrary number. It's very complex thinking, but what we're going to do is we're going to look at how we record that. So some states do not require par, but that doesn't mean they can't use par. So before we get to the journal entries, there is something called the IPO. You should know what it stands for. It is what is called the initial public offering. Every company has one. You only go public one time. Now, can you sell more stock? Absolutely. But you go public one time. And it's very important to do it right, because that is when you get the biggest bang for your buck. When you go public the first time, that is when people are jumping at your stock. That is when your stock might start at $15, and then everyone's like, I want that stock. So the stock price does what? Goes up. Last year at this time, I don't know if anyone can help me remember. It's a really funny name. It's similar to Yahoo or Amazon. It's like, you don't laugh at me because I'm going to say it wrong. It's like Yalibaba or Yabababa. Alibaba. See, I was very close. Went public in my spring semester. And it was a big deal. I have no idea. I locked your computers. I have no idea how well it's doing. But it was a big deal because it was a foreign competitor to, I believe, like an Amazon. I think so. I think that's what it was going to be. It was doing very well, and I could be wrong on this one too. I think it came from China. It was doing very well over there. Google obviously went public and did very well. They did their IPO a little different. They set their price. A lot of times you don't set their price. You kind of let the market set your price. They set their price. But the Google boys, they haven't done anything normal. They've done everything they want to do their own way, and it's worked for them. So, but it's very important to do it right. You want to make sure you go out at the right time. You want to make sure you have everything out there that people can go out, and then you issue your stock. What happens when you decide to do it again? It's called a season new issue. When you sell your 1 million shares that you originally went to the SEC for, and now you need to sell more. That's called a seasoned new issue. All right, so, or a second issue. So you can do that. But you usually don't do that until the demand is high enough that you want to go out and offer more. Because remember, what happens if I sell that 1,000,000 shares, that's great. But if I go and offer another 1,000,000, what am I doing to my ownership of the company? If I have 1,000,000 shares and I buy half of it myself, so I own a 500,000 and I sell the other half, but now I go into the SEC and ask to sell another 1,000,000, what do I have to do to keep my ownership? I got to buy another 500,000. So if I'm offering it and it's selling for $100, I have to buy it. You don't just get to keep X amount. The company has to be able to keep it internally. Right? So it's very tricky once you get in there to make sure you keep that part of your company owned by you. So let's look at a couple journal entries. I can leave that up there on the board. So National Beverage sold cash transaction. Remember, what is the only reason? The only reason we sell stock? Money. Because you're giving away your company. There's no other reason you sell. So if we sell 100 shares of stock, it's selling for $20. I'm sorry, 100,000 shares of stock. Selling for $20 a share, $1 par. First of all, what am I getting? $20 per share, 100,000 shares, so how much cash am I getting? 2 million shares, or 2 million? So cash is going to go up by $2 million? All right, what am I going to credit? Someone said it. Contributed capital, or let's be specific now. It's not going to be contributed capital. It's going to be called common stock. Because now we also have preferred stock and treasury stock. So it's no longer contributed capital, so common stock. Is it going to be common stock for $2 million? Because what did I say about putting it in there at the stock price? No. We're actually going to take 100,000 shares times par. So when you do the journal entry, you take the 100,000 shares times the par value. So 100,000 times 0.01 is, I think it's 1,000, isn't it? And the rest goes to an account. I'm going to abbreviate it, but I'll tell you what it is. It's called additional paid-in capital. Additional paid-in capital means additional money, and capital is what runs the company, additional paid-in capital. So when that money comes in, we got to write that wonderful thing out. That's what the journal entry looks like. So we got $2 million. We put 1,000 of it into common stock because it's constantly changing. So we don't want $2 million in common stock because tomorrow common stock might not be worth $2 million. Common stock might be worth $2.2 million. Common stock could be worth $1.8 million. So we put it in there at this par value that does not change. That lets investors know that yes, I sold 100,000 shares of stock. And the rest goes into this additional paid-in capital that yes, in fact, increases my equity. And it's just additional, it's called additional paid-in capital. Can it go up? Absolutely. Can it go down? Yes, it can. Now what happens if Nick decides to sell stock to Colin? Do I care? No. That happens every day on the market. It actually doesn't affect the company. Once I have my IPO, that's the biggest effect on my stock. Now, it doesn't mean I don't sell stock. It's the biggest effect on my stock. After that, Eric could be buying my stock, or he could be buying Nick's stock, or he could be buying Colin's stock. We don't know. When you go out there and decide to buy AT&T stock, you don't know who you're buying it from. If you go through an advisor, you could be buying it directly from AT&T. All right? You could be buying it from Brianna or Red. All you know is you told them you wanted to buy 10 shares of a stock. And next thing you know, you own 10 shares. The way it's set up now through computers and electronically, we don't really know who we're technically buying it from unless you just look at Anthony Brennan and say, I will buy your stock. And then you know where it came from. Does it matter where it came from? No. As long as you know you're actually buying real stock, it doesn't matter where it came from. Each one of you guys could tomorrow, right now, log on to any site and probably in the next 10 minutes buy a share of stock. It didn't used to be like that. And I think it's what, $7? Does that sound right? I have not done it, but does that sound about right? $7 to trade? I think that's what they advertise. So it's very cheap. Now, do you want to go out there and buy a share of $7 stock and spend $7 to buy it? That wouldn't necessarily be very smart. But any one of you guys can do it, and that's one of the perks of everything being so easy on the computer. But it also is a drawback. Are there a lot more uneducated investors today? Yes. Did I already ask this question? I can't remember if I did or not. Are they more men or women that trade on a regular, high-frequency basis? Men. Men tend to trade, buy and sell much more frequently than women. Women tend to put their money in investments, but then they tend to leave it. Because men tend to be more risky, and women tend to be more, let's let it sit. All right. So stock, one thing we use is stock is used to compensate employees. Now remember when I said companies buy their own stock? All right, so companies buy their own stock. Well, one of the things they do is they give it to their employees. They give it as compensation. So they might give it as a stock option or as any type of a benefit to their employees. Well, you can't give an employee stock if you don't own stock. So the stock options, if it's used like as a stock option as a goal, it might be where you have preset targets that you have to meet, and if you meet that, you get stock options. Stock options are, and again, I think I already did this in my tax class, which is why I feel like I talked about it. Stock options are where something like this happens. So at AT&T, when I worked there, you were given stock that they said you are allowed to buy 40 shares of stock starting on July 1st. You can buy the stock at $42. You have it for 3 years that you can buy it. So starting on July 1st of next year, I can buy 40 shares of stock at $42. And I have 3 years in which I can buy it. So where is my benefit? If this price goes up at all, right? So let's say now it's next July, and I haven't decided if I want to buy the stock, but the stock's selling at $45. Is it an advantage to buy it? It could be. A lot's just going to depend on whether or not I think the stock's going to keep going up. Because if it's at $45 July 1st and I can buy it at $42, I already made $3 a share. The question is, do I think it's going to go up, or do I think it's just going to kind of stay around that price? If I think it's going to go up, then I might as well buy it. Or I can just sit there, because I have 3 years and only 6 months has gone by. So I wait another year, now it's been a year and a half, and the stock's at $52. So now it's $10 higher. Do I buy it? Now I might buy it. Because now I make $10 a share, and now I've made $400, and I haven't done anything. So what Daniel says is then you can hold on. Now what some companies do on top of that, and what AT&T did, is AT&T grossed up, and they provided a buy-sell intermediary. Meaning Merrill Lynch came in, and they were able to help you buy-sell. Meaning that if I wanted to buy the stock and immediately sell it, I didn't have to have the money. So what I did, this stock option came about right around the time, well, the option came about ahead of time, but the timing was shortly before I got married. So we were watching the stock, and we're like, okay, how high do we go before we get scared it's going to start going down? And we were watching, it got in the 60s, and it actually was 42, but I can't for life remember how many shares I had. But it was 42 that we could buy it at, and when I say we, I mean me. And we were watching it, my husband and I, and it got up to 60, got up to 62, and then I'm starting to go, we got to sell it. My husband's like, typical guy, oh, it's fine, let's watch it, it's going higher. I'm like, how much higher, how much higher? So it got to 70, and at 69, I put what's called a buy-sell. And it means that any time during the day, and we watch the market, right, where you saw it went up and it went down in like, what, 5 seconds? At any time it hit 70, they sold. So sometime during that Tuesday or Wednesday, it hit 70. They bought my shares and they sold it in that same instant. And so I bought and sold at 70. And so I got that $28 a share at how many shares? I can't remember. It was 40 or 60 shares, whatever. But it was a nice chunk that I didn't have to come up with the money. I just got the difference. Because that was a compensation for the company and our department hitting some goal. I can't tell you what the goal was. I was just happy that it came about a couple months right before the wedding, to help pay for a chunk of the wedding. It was it was one of the perks. They don't do that very much anymore. Now, can stock options go the other way? Absolutely. Now, mine was great, and most people during that stock option did get their money out of it. Now, shortly after that, I also left, all right, went to a different company because they started moving everybody to Texas. And friends of mine, there were more options, and they didn't exercise them. They kind of kept waiting, and they were exercised, I think, at 40. But the price kept going the other way. So it's a great compensation if the price goes up. But here was stock options given as a thank you for doing something, and then the price went down. So it can be a nice reward. You can say, yes, I'll take stock options. But then if the price goes down, your bonus package just went the wrong way. So there's a plus and a minus to it. So when a company buys its own stock, besides that option, there's a couple things they could be trying to tell investors. So we're looking at this portion right here, the treasury stock, when we're buying our own stock back. Number one, they're trying to send a signal to other companies, to investors, that our company is worth buying. So why would I buy as a company? Why would I buy my own stock if I don't think my company's good? Besides trying to send a signal. But think about it. If a company's buying their own stock, they're spending their own money to buy it. So if they're spending their own money, they got to hope that they're going to turn things around, because that's not a good thing to do. They're better off buying stock in Verizon, right? If they're trying to make money, if they think their company's going under. Another one is to obtain shares to reissue for purchase of another company. When Tyco bought out Mallinckrodt, and same when InBev bought out AB, they have to give shares of the new company to everybody that owns shares of the old company. So when I got bought out, when I worked for Mallinckrodt after AT&T, Tyco came in about 2 years after I was there and bought us out. And for every share of stock that I owned in Mallinckrodt, I was given 3 shares of Tyco. The only way Tyco can give me 3 shares of its stock is if they have enough shares that they own. All right? They have to own the stock. They can't give me this. That's not been issued. That's not theirs to give. It's just sitting there. The only stock they can give is their own stock. So think about how much stock they had to have if they had to give out stock 3-to-1 ratio. And InBev did the same thing. I don't remember what the ratio was for InBev. It might have been 3-to-1. All right. Obtain shares to reissue to employees, a stock option, which we already said, and then reduce the number of shares outstanding to increase the per share measures of earnings. So if you take them out of here, then you're increasing your ratios here, which could increase profitability for your shareholders. Okay, so repurchase, we kind of talked about the stock options already, so we can go through that. Now, when we repurchase, I already said, no voting rights, no dividends, all right? And it creates what's called a contra equity account. We already know what our contra equity accounts are. We got accumulated depreciation, we got allowance for doubtful accounts. Those are about contra assets. Where does common stock go? Is it an asset? No. It's under stockholders' equity, so this is a contra equity. So if stock carries a credit balance, what is treasury stock going to carry? A debit. And if you're looking at a T account, kind of like when we used to do accumulated depreciation, here we have common stock with the balance. Treasury stock is going to be that T account right underneath it, carrying a debit balance. Right? It's a contra account that's going to reduce stockholders' equity. It is not an asset. Whenever we hear the word contra so far, it has been an asset every time. This is not an asset. And every time we record treasury stock, we always record it at cost. Doesn't matter what the market is, it's cost. What did we pay for it? So let's look at an example here. I'm going the wrong way. All right. So if we have National Beverage, which owns some wonderful drinks called like Faygo and Shasta, and you guys ever drank Shasta? Okay, it's horrible. Faygo's good, but Shasta is absolutely horrible. We'll pull up its stock in a little bit. If we acquire 50,000 shares of our own stock, what is the company doing? We're reacquiring our own stock. What is my journal entry going to look like? Is it going to look like this? No. Why? I'm going to credit cash, exactly. If I'm going to get treasury stock, I'm buying it. Now, I said that we're going to record it at what we paid for it. So we bought 50,000 shares. There's only two numbers on this one, so this one shouldn't be hard. If I bought 50,000 shares at $25 a share, how much cash am I spending? How much? $1,250,000. What's my debit going to be? What? Huh? Treasury stock. It's not a hard journal entry. It really is that simple. Yeah. Huh? Well, that's why it's a contra. It is.
Oh, okay.
All right, because it's a debit. So it's taking the stock out of our stock. We're buying stock out, and we're putting it. Well, I'll show it to you on the balance sheet here in a second. Okay. What? Yep.
What about the par value?
Par value doesn't, not when it's treasury. Treasury, we're buying it at whatever. Just like if you wanted to go buy this National Beverage stock, you would pay $25. So me as a company has to pay $25 too. All right. Par value is only when it's sold on the open market directly from the company. Okay, so this is when the company went out on the market and bought the stock. Now, I want to go back, Daniel, to something you just said. When you said it came out of outstanding, it's not coming out of outstanding, it's coming out of issued. So let's say, what did we say at the beginning? We had $1 million. We said we had 750,000 issued, 250,000 non-issued. At the start, all 750,000 of those were outstanding. Now we bought 100,000. Now we bought 50,000 back. So now we have 50,000 here, and now we only have 700,000 here. Because out on the market, we bought those back. Okay? So we are pulling them from outstanding, but they're really being pulled from issued because we took them from the market. All right, so now this is what happens next. If we don't give them as stock options, at some point we're going to sell them. We're either going to give them back as like AB did and Tyco did when they bought other companies, or at some point we're going to sell them, which is okay. And why would I want to sell my own stock? Hopefully to make a profit. Hopefully. So now I'm turning around and I am selling 5,000 of these shares back on the open market. But I'm selling them at $28 a share. So I'm actually making money, right? I bought them at 25. Now I'm selling them. So the first thing is, what did I get? Cash. And I got 5,000 times 28. What is it? 140? Which is 140,000. But what do I have to take out of treasury stock? I have to credit treasury stock for 5,000 shares, but I have to multiply it by how much? 25. Because otherwise, it wouldn't equal out. I can't take it out at 28 because I didn't put it in at 28. So that's only going to equal 125,000. Where does the other $15,000 go? I made money. What other account on the board is where I put money that I made? That's additional money. What? APIC, additional paid in capital. For this chapter, we have this new account called additional paid in capital. Whenever we make money that just is extra money on stock, it's additional paid in capital. Additional money we make. That's how you can also look at it. Additional money we make. Yes, sir.
This might sound like a no question.
No way.
Okay. So if you're putting in common stock of only 1,000,
Okay?
because the very first one you're putting on the par value,
Yep.
how can you take out treasury stock for like a lot more, even though?
Well, okay, we're not taking it out, first of all, okay? So it might be $1,000 over here, and what was that? 101 million, okay? But that is a value, and they're not comparable values. So I'll show it to you on the balance sheet, and you're going to see how it presents. They're not like, it's not like equipment. That equipment shows 300,000, and then it has accumulated depreciation of 5. So book value is 295,000. It doesn't show up like that. All right, so let's look at a problem.